Okay, welcome to this presentation of Storm Real Estate. We have in Storm we have a very simple strategy. We do real estate in Russia, and we have a financial portfolio. But the most important is that we are. Personally, I'm the largest shareholder in Storm Real Estate, and just as our shareholders, we will then never compromise shareholder returns. Looking at what we did during third quarter, we had revenues of 2.9 million US, which is up roughly 10% from last year. And we have now an NAV per share of roughly 25 Norwegian kroner. The share is trading around 14, and the financial assets of the free financial assets assets of the company is around 20% below that level. So, which means that half of the company, or 2/3 of the balance sheet, is office buildings. One in St. Petersburg, one in Moscow, and the other part is financial investments, partly ownership in other real estate company, and partly high yield portfolio and cash. The last quarter, we've been very happy that we had quite a lot of cash in the bank, and that bank have a good credit rating. So, what did we do during Q3? We have the asset values of the real estate portfolio in Russia has continued to increase, and has had a remarkably increase this year. However, it's still below peak levels in 2008, and most importantly, the yield on the market values on the NAV that I just showed you is more than 9%. And it's important to see that you have, the big investment case is that you have, for example, just as much office property in Moscow as you have in Oslo. There are roughly 16 times the amount of people in Moscow than in Oslo, and our big advantage over there is that it takes, instead of 1 year to build a new office building and create supply to the market, in Russia it very often takes 5 years, which means that you can't really fill up the gap. And there is also the core of our strategy of having a financial portfolio and buildings, because everything in Russia takes more time than over here, and it's very important to think things through properly before executing. So, we had, and again, we have a very active liquidity management, and of the financial portfolio, roughly half was in cash during Q3. And what do we have? We had, in Moscow, we house the headquarters of Gazprom's pipe maintenance business. They have around 1,000 workspaces in that building, which is 14 stories and 15,000 square meters gross. Gazprom has spent around 5% of the value of the building on refurbishment, then primarily on the CEO's office on the 14th floor. So we do believe that they're intending to stay, And what's good is that there are a lot of pipes in Russia to maintain. Most of you obviously know that Russia is the largest country of Europe and goes far into Asia, and it's all pipe laid. So Gazprom Centermont has an annual budget of 130 billion euros, which comprises to around 25 billion Danish kroner per year, and they need this main office, which is very close to the headquarters of the parent company in Gazprom. And it's also, again, with the pressure on the office property in Moscow, we're also happy that they're running, even though they spent so much money in the building, they're running on quite short contracts. So last year we had an increase of 10% in dollar terms on rent, and we also expect this to increase going forward. And as long as Gazprom stays in the building, we have from 0 to 10% per year annual uplift in dollar terms. The finance of the buildings are in US dollars, with a loan to value of around 50% today, and with interest rates on at very competitive rates compared to what's obtainable now in the current market. And next time we need to refinance is in 4 years. Looking at the financials, the balance sheet, the income again, we expect and anticipate, the actual running of these buildings are of the 22,000 square meters of buildings in Moscow and St. Pete is very boring for the investors, because everything is as usual above the operating results. We work continuously to take down the cost of running these buildings, but the main many of the main sources of income you will find below the line. And as many of the other companies here today, we have had loss on the on interest rate forward contracts. The 30th of September this year, the interest rates, long-term interest rates, were at its very, very lowest point, which means that in Q4 we have made money on interest rate swaps. And we also, at the end of last quarter, we had 90% of our loans bound for almost 10 years, that we also took some profit on during October, and reduced it to a more normal level of around 70%. We have an opportunistic view on this part of the portfolio, and over time from time to time, we've actually made more money on interest rate swaps than we made on rent. Looking at again, if you want to analyze this company, it's extremely important to look at the very bottom of this line, where it says total comprehensive income, net of tax. Because we have a Norwegian mother company listed on the main board in Oslo, and because we invest in Russia, we have Cypriotic companies in the middle, and then the Russian companies owning the real estate below. So IFRS will confuse a lot. IFRS is what we have to present to you, but the comprehensive income is basically just what we have now minus what we had last time we presented. So that's what you should look at. And the other part is obviously then the NAV per share in US dollars. US dollars is our base currency, and we are listed in Norwegian kroner. So again, that's why the figure I gave you was in Norwegian kroner. That's the one you can compare with the share price. the comprehensive income was negative in dollars in third quarter, and it was positive in Norwegian kroner because of the currency effects. Looking at the balance sheet, the total balance is around $150 million. The market cap is around $50 million, and the net assets is just below $100 million. And we have, again, this is a very important investment for me personally, and also Storm Capital Management, who manages the company. And we have, during the year, through buybacks and dividends or paybacks of already paid in capital, we have delivered back to the shareholders around 20% of the current share price. And we will continue to have a very, very generous policy of buybacks and dividends as long as we see that as profitable for the investors. And again, we look every investment we scan, we look up on in comparison to our own share price, and therefore we have maximized the level of share buybacks according to in relation to what we have managed to increase the NAV of the company. So the NAV has been fairly stable over the last years, and we've actually been paying out most of what we have made. Looking down at, if you break down the cash and liquid investments, you will see that we had around 44% in cash at the end of the quarter, and around just below 40 in Storm Bond Fund, which is then the high yield fund of the Storm Group, in the share class without fees, because we already charged to run Storm Real Estate. And that bond portfolio had an average yield to maturity after the crash in the credit markets, because it has been quite turbulent there, of around 14% and an average duration of around 3% at the end of the quarter. And this is spread on mostly in Norway, and mostly in oil and oil service companies with very, very healthy security, especially after Norway found a lot of oil during the quarter. And this is the overview of the portfolio again. The average yield, the average realistic yield is a combination of the weighted yield to call and the weighted yield to maturity, so around 14%. And the credit quality is, well, it's mostly single B rated companies, and they have been hard hit during the crisis. But on the other hand, they also yield a lot. So the portfolio as a whole, at the last counting, was up for 2011, but with a lot more potential than it had before. So the idea is that if you invest in this company, you should accept some risk, either in properties or in then yielding bonds with around the same expected return. And looking at our share price performance, we have suffered as many, but we have also the shareholders who invested in this company during the summer 2008, before Lehman Brothers crashed. They have had a return of around 60%. Mostly, and most of that has actually been paid out to the investors through buybacks or dividends, and that will continue to be so, hopefully. Because of the financial deals that has been done during the period, the company is still priced only 20% above cash levels or financial free financial assets, which makes the buildings in Russia that many see as obviously risky, but also an enormous upside, almost for free. Looking at the market, Russia is a very, very interesting market. The reason is simple, and the macro drivers are exactly the same, in fact, as in Norway, although obviously less transparent for the Scandinavians. But you also get paid for that. You get paid around 500 basis points more than for prime real estate in Moscow and St. Pete than you get paid in Oslo, for example. And so you can actually accept a bit less transparency in the market. You just have to make sure that you're not too creative. I mean, we don't need to do expensive developments. Development is very difficult to do in Russia, and especially, as I mentioned, with the lead time of building from planning to completed building around 5 years, which means as well that it's the net present value of such a building is in many cases zero before you start when you start building, because you have such high requirements of return on your capital. So when Russia is going, when the rest of Europe is going down, Russia is really now coming up, and the credit rating of Russia is a lot better than many of the European countries. And also, they don't have to drag on to Southern Europe. I mean, that is unfortunately the problem. We also believe a lot for example, in Germany, but they have an inevitable risk of being first-class economy, but they're still on the sinking ship. I mean, also the first-class passengers on Titanic needed to leave the ship before it sank, and that's why we think it's sensible to mix now the developing world, the BRIC countries, and the Western world, in a way to have the best of both worlds, where, yes, in all the BRIC countries there are certain risks, but you have growth in the underlying economy, the underlying demand, and again, even though the number of people in Russia are falling, we do have everybody is coming into Moscow and St. Petersburg. Those cities will continue to grow for many years to come. Looking at commercial real estate in Russia, we will see that the number of transactions has gone up. However, we will also see that the number of foreigners in the market is still at a very low level. And as we have seen that so basically, the prices we have now is a lot domestically driven. And it's only an added bonus if the Brits, and the Americans, and the Scandinavians come back into that market. So we have chosen to stay in the market and be conservative. Looking at the property clock of Jones Lang LaSalle, it's also sort of trying to sort of figure out where are we actually when it comes to rent rates. And what we will see is that Moscow is in the forefront of increasing rents. And the reason is simple: there are not many, it is not a lot of office space left. Well, you would see on a further slide here that we have a vacancy of still around 10% in Moscow, but 10% vacancy in Moscow is full because it's so much office space placed in places where you don't want to be in Moscow. It's very, very segmented. And so that's why we have a great increase in rates, even though we still have some vacancy. And when I say around 10% vacancy, that is also has to be seen aside a vacancy rate that was up to 25% a few years ago. Looking at St. Petersburg, it has been a lot tougher over there. And you would see St. Petersburg, you would find at the bottom of the of the clock, where rents have just evened out. And we have, in St. Petersburg, we have therefore secured another 3.5 years of rent with a very, very secure tenant, having all our property in St. Petersburg, where we believe that when that contract expires, also St. Petersburg will have come back to a healthy level. So again, looking back at the vacancy rate, you will see that the rates are going up and the vacancy rates are going down. And you would see that the figures have much larger fluctuations than you would see in for example, in Copenhagen. But what we see also is that a company like Gazprom Centremont wouldn't just move because it was 10% less somewhere else, because they have spent so much time and money to make the office look as a state-of-the-art office with, for example, alligator skin on the walls up in the 14th floor. Looking at St. Petersburg, again, there were a lot of projects that started before the crisis, and many of the developers have managed to just finish them off before this crisis. That's why we stay put and are very, very happy with a building where actually one of the owners of our tenant, which is a pharmaceutical company working mostly against America, one of the owners has an apartment in the building and his kids go to school around the corner. So that's a very good sign. Looking at opportunity pipelines, looking at most of our peers who have entered Russia, they have gone too fast and they have done big mistakes. And many of them are now half bankrupt or almost bankrupt. I mean, we will never compromise when we buy a building on either we buy it so cheaply that it's such a big discount that we don't need finance, like we did in April 2009. We bought the building at practically half price. Then we paid cash. We refinanced it and took out everything we put in. But if you buy in a market like you have now, which is, I would say, it's an okay market. It's far below 2008 levels, but still, but it's not rock bottom. Then we need to have finance up front of at least 60% loan to value, and we need to have also that finance from a respectable bank that we believe will honor their loan also in bad times, and therefore we have worked now. Again, the processes are long, so it's very important that the money is working elsewhere whilst we are waiting. This particular building, it's a 2-year-old building in the center of Moscow, 10 minutes walk from Kremlin, and we buy it 20% below new build cost, which is we're very happy with. And the building is state of the art. Nothing will be needed to be done, or hardly anything will be needed to be done the next 10 years. So we hope that goes through, but again, we do not compromise. The most important here is shareholder return. So back to our strategy. It's high quality real estate, and it's also financials. So I don't need to, and we are in a way well positioned for growth because we have a strong balance sheet. The market is, the financial markets are such that many investors, many closed-end funds have to ask their money back because they have to pay back to the investors. By that I sum up. Again, strong balance sheet, pure exposure. We have a solid track record. We have a financial track record. In fact, so we're not bound to stay on this track forever if we feel it's better for the shareholders to divest, for example. So we're open for opportunities, but and we look rather on the downside before we look on the upside. And that's also when you get the long-term upside in our view. Thank you very much, and then open for Q&A.
I'll ask you in English just to keep the language going. You mentioned that the size of your cash and cash equivalents being investments in other players as well as your strong platform and real cash. So effectively what you're saying is you have almost the full value of the company standing on cash or cash lookalike things. And so we are effectively buying the Russian property exposure for free when we buy the share.
That is correct.
And the NAV, or the price right now, is you have bought back shares of, I think 5% shares in this quarter, right? And you paid out an additional 10% dividend earlier this year, which was 10% net of taxes.
That's right.
So there's roughly 20% of return to shareholders alone this year.
Yeah.
Back.
And we also bought back we bought back a total of 10% the last year, and we just scrapped 10% of the shares. So we can do the same again. And we will do that as a combination of dividends and buybacks as long as the market prices us at a discount.
What are the banks you work with? Is that typical Swedish banks? That we heard earlier that the Victoria properties, they used the Danish banks who ended up with a lot of Berlin properties on the balance sheet. Is that typical Swedish banks that did the same in Russia? Or?
Well, yeah, we work with our main bank has a Tier 1 capital ratio of 14.8%, and it's a Scandinavian bank. And it has been a very, very, very good, strong partner throughout the years, and also financed the Griffon House in St. Petersburg for us this year at rates pre-crisis levels.
Well, can you give us an update on the Eastern Properties holding that investment? What has happened, or
yeah.
What's out there right now?
Yeah, what we did earlier this year, or starting last year actually, when just after I was here last year, we found we had followed a company, a peer group company called Eastern Property Holdings in Switzerland for the last 8 years, or since they were established in 2003, and we saw that their NAV was around $80 per share, and we could start buying at $20 per share. And we also saw that 2 of their parade buildings were for sale in town, and broker rumors was that they had cash offers at around $40 per share. So you basically would then get the rest of the portfolio for minus $20. And so they sold these 2 buildings, Geneva House and Berlin House in Moscow. One of them is the headquarters of Bank of America in Moscow, and they made all this cash, and they were thinking about not paying it out to the shareholders. So we did a big job in Switzerland in May and June and July, where we highlighted all the corporate governance weaknesses of this company that made the stock be so cheaply priced. That resulted in a dividend yield on our cost price of 25% in September, and also that they changed the board to become an independent board with very strong board members who definitely have shown that they do not compromise. So we believe that the company is on track, it's very strong finances, and that it will continue to pay dividends, but that also, more importantly, they will deliver on their projects. And they do have development in the portfolio, but today's share price is actually, now it's priced on net cash after divestment and after dividend payout, and we see a great upside in the rest of the portfolio.
So what's the net asset value now?
The net asset value is $64. They also took down the net asset value after we, I would say, highlighted the fact that there were some assumptions in the NAV that we thought could be slightly lower, and that made them take down the NAV and also thus the management fees of the company, which was important. So it's now $64 and the share price is $21.
So roughly the same as your acquisition price? How do you got
we have been trading this stock up and down all the way, and our acquisition price net is significantly lower than the today's share price. So that's what we have done. I mean, we have a very, very active liquidity and a financial portfolio view. So we have both bought and sold shares every quarter the last year.
Thank you. Are you looking at other opportunities right now?
We're definitely looking at other opportunities, and the market has created a lot of good opportunities lately. So I do not rule that we will do something similar again in other companies, and we are also we are also thinking about trying to potentially increase the scope slightly, so that we can also invest in highly discounted companies on the Nordic exchanges, if we find the jewel there.
Okay. Then I have two more questions. One regarding the new opportunity, the real estate you're looking at. What kind of financing split are you looking at?
Yeah, the new opportunity is it's about it's 9,400 square meters of real estate. The new build cost was $55 million. It's a very efficient structure when it comes to extracting future revenue streams out of Russia, because the seller is an international listed company. They have structured everything in the same way as we have. So it's all well prepared. We see that in that area, we see a clear potential, because it's an area of Moscow which is again very close to the Kremlin, which is in constant development, and we see it as realistic that we'll see a yield hike of 100% the next 5 years, and with loan to value of 60, that will give very, very good economics. And we were able to buy it at that price now due to the lack of finance in the market.
So you're going to put 40% roughly?
Yeah, 40% roughly. So that's what we have. We have that cash free today. So that's why we've we in these rough markets, if we suddenly, we don't want to jeopardize the fact that if we get an offer we can't resist, it's important not to have the money places where it takes time to take it out.
Thank you. Final question. Do you do any kind of hedging on the real estate values in Russian rubles? Do you accounting do it?
Yeah, it's we do that. We have a floor on US dollars, or we have a ruble floor in the contract. Currently, it is depending on contract, it's between 27 and 30 rubles to the dollar. Which means that if we have a very strong ruble, we will get more dollars. But we have that floor so that everything we communicate of rent rates is usually on that floor, and then it's a bonus if the ruble gets very strong. And it's very exciting right now because the weaker the US dollar, the higher the oil price, and the better it is for the Russian financial world.
What kind of duration do you have on those contracts? How long are you protected?
Well, it's again, that's in St. Petersburg. It's another 3.5 years, and the tenant has already been there for in part of the building since 2006, and the other part 2008. And in Moscow, it's an evergreen contract that can be terminated on 3 months' notice. And we have the right to increase the rent rate in dollar terms by 10% if the general market also is up around 10%. So at the moment, we do expect a rent rate increase next year, and of course we hope to be able to communicate that rent increase is 10%.
Så vil jeg sige tak til Morten Astrup. Og det er hermed slut for i aften. Håber at se jer igen til næste år til kommende nye arrangementer.